Hello and welcome to this week's MoneyFit Live webinar. My name is Todd Christensen, Education Manager at MoneyFit and author of Everyday Money for Everyday People. Today's topic that we're going over is your credit and car insurance, how your score can affect your monthly premium, and what you can do to fix it if you need to. We're going to go ahead and get right into the basics of your credit and car insurance. Your car insurance, you actually have a car insurance credit score. Most people have heard about their FICO score or the Vantage score, but most people don't realize that they have a separate, though similar, car insurance score, and that its score is also going to look like your FICO from 300 up to maybe 850 or in that general vicinity. Why is there a credit score just for car insurance? Because it is a tool in predicting the likelihood of losing money for the insurance company. Insurance company, the whole point is to, what they're trying to do is to be able to provide coverage for their customers, but do so while minimizing the potential for loss, minimizing that risk. They don't want to penalize you if you are a low-risk driver, a low-risk homeowner, because it's not just car insurance, it's homeowner's insurance, and it's also renter's insurance and car insurance. It's not a factor in your health insurance, in case you're wondering, but it is in these others. And life insurance as well, if you have a private life insurance policy. They are trying to minimize the penalizing you if you are low risk renter or driver and so forth. How does this have to do with what is credit? What is the way you manage your credit? Because your car insurance score is based on your credit history. FICO has a specific auto score, the FICO Auto. LexisNexis Attract is another one of a very common car insurance score, as is the TransUnion Credit Vision. These are some of the scores out there that are used in determining at least a portion of your monthly premium. How does it affect it? There are multiple factors. Things like age. Now this, of course, when you apply for a car insurance, you know that your driving record is going to be a factor. Everybody knows that. But most people also understand that there are other factors. Age is one of them. Young people, brand new to driving, tend to get into more accidents and generate greater costs to the insurance company than somebody who is 35, 45, 55 years old. So your age is going to be a factor in your monthly premium. Your claims history, if you have been in an accident or somebody else has hit you and you have to make a claim for that repair, that's going to be a factor in your in establishing your monthly premium amount. The coverage and the deductibles that you choose. Obviously, if you choose higher deductibles, it means that if there's an accident, the company is going to have to pay less. And so your monthly premium is going to be lower. Your credit is a factor. These scores are one of many factors in your monthly premium amount. Your driving experience. If you could be 30 years old, if you've never had a license before, that could be a factor. Or if you've had tickets, so forth. There's your driving record. Your gender. Wait a minute, that doesn't seem fair to one of the genders, right? But yes, it just so happens that women get in fewer accidents and cause fewer losses to companies than men. So men will have higher premiums than women, all else being equal. Marital status. Single people get into more accidents and cause more damage or more loss to the company than married people. That's again, that doesn't necessarily seem fair. What if you're a great driver? The insurance company is trying to lower the risk as much as possible. So they look at all these they call these pools. They look at all these different risk pools. The fewer risk pools you belong to, the lower your monthly premium is going to be. The more of these risk pools you belong to, if you're 16, if you've had an accident, had a ticket, if you have poor credit or no credit, if you're a male and you're single, all these things are working against you. And it goes on. The number of miles you drive, if you do a lot of driving every day, you're more likely to get in an accident than somebody who's just driving 3 or 4 miles a day or 10 miles a week. Your previous insurance, if you didn't have previous insurance, again, it's harder to predict what you're going to be, what your claims are going to be like in the future, so they're going to assume you're higher risk. Where you live. Surprisingly, if you live in a rural area, you're going to pay higher premiums than people who live in urban or even suburban. The only way I can figure that out is if you do get in an accident on a rural highway, it's going to be much worse than if you get in a fender bender at a downtown where you're going 20 miles or 30 miles an hour versus 60, 55, 60 or higher in the rural locations. The type of vehicle and how you use it is going to affect your policy. All of these things can cause frustrations because we just feel like it's unfair. I did. I got my first car when I think I was 22 years old. I was 22, so I was young, first time insurance on my own. I was a male, I still am. I was single. I had a couple of tickets from 4 years earlier, but there was a couple on there. Actually, I think it was just one. But I hadn't been in an accident. I'd never hit any other car, and my car. Oh, and my first car was a 2-door little British sports car. Only a name only. It was, you had to push it downhill with a sail up to get it to 60 miles an hour just about. But because it was considered a sports car, all those things put together, my monthly annual premium was higher, and this was just for liability, was higher than what I paid for the car altogether. And it was in decent shape. But my insurance premium was through the roof, even though I had never been in an accident. So that's just the reality. If you belong to multiple risk pools, your monthly insurance premium is going to be higher than if you don't. So here are the studies. There are actual studies that show that if you have, relating to credit, that show if you have poor credit, for whatever reason, it doesn't matter, whether it's medical debts that you can't afford to pay, or whether it is just taking out a bunch of credit cards, overspending and not paying them, it doesn't really matter. The fact is, from the studies, that the lower your credit, the more you are going to cost the insurance company. And this is back from way back in 2003, but it does show that your credit score, people with excellent credit, are going to cause 30% less cost over time than people with the worst credit. And then there was a 2000 study, review of studies from the Federal Trade Commission that said insurance companies use scores as a factor when estimating the number and total cost of insurance claims that prospective customers are likely to file. So that's why they're looking at your credit scores as a factor in your monthly premium, because it does affect the number of claims you submit and the total cost of those claims. So what can you do? First of all, when should you care? You should care before you get a car loan, before you buy a car and are going to need insurance. You should care before you get into a new home or into a new apartment where you're going to need homeowner's insurance or renter's insurance, or before you get a life insurance policy. Before you get yourself into a position where you need insurance, take care of cleaning up your credit. How do you check it? You can go to annualcreditreport.com to check your standard credit, look for anything that's inaccurate and dispute it. There's at the end of every credit report that you get at annualcreditreport.com, it lists the instructions on how to dispute any inaccuracies that you find. What can you do to speed up your credit building or rebuilding process? How do you improve your score the fastest? One, dispute those errors. If you find something that's inaccurate, you go back to the company, the consumer reporting agency that provided that report that has the error on it. So you go back to Experian.com, Equifax.com, or TransUnion.com. Right on the home page, there's going to be a link that says dispute errors. Click on it. It'll ask you for the report number. You put it in, or you put in your access your account. It's all free. And then you scroll down to the error, indicate that it has an error on it, choose from the drop-down list of explanations why you feel it's an error, submit it. You can upload some documentation, but then it should take about 3 to 4 weeks, but they have up to 30 days to respond if they're going to respond at all. Get current on any payments that you've missed or that are late. Make that payment as soon as possible, and get it off your. If it's more than 30 days late, it will probably get onto your credit report. Call if it's the first time you've had it in forever. Call and let them know. Ask them if they can stop reporting it. Get caught up on it, but get current on payments. That's probably the fastest thing you can do if there's accurate negative information. Pay down your balances as much as you can, from home loans and car loans to credit cards and retail accounts and collection accounts. Faster you can pay down your balances, the less those high balances are going to hurt your credit rating. So disputing the errors, again, that's critical. Go to annualcreditreport.com, get your free credit report. Then whichever consumer reporting agency has a report with errors on it, you go there. It's free. It takes anywhere from 5 to 15 minutes to report an error. And if the creditor comes back in that 30-day period and says, no, we think this is accurate, we don't think it's an error, then you have to contact that creditor directly, call them, write to them, but keep track of every single point of contact that you have and anything that they promised to do and who you spoke with and what the time that you spoke with them. All that information is going to be maybe important down the road if you can't get them to remove the error, repair the error. Now, what can you do long term to protect your insurance score? These are things that you can do to build or rebuild and protect your main credit score. Pay every account on time, every time. That's the main thing you can do to build your credit. Pay down debts to zero. Keep them at zero if you got a credit card or store card. In fact, if you have store cards and you use a store card, don't even leave the store until you've stopped at the customer service desk and paid that balance off to zero. You don't have to carry a balance to have excellent credit. That's a myth that is out there. You can have excellent credit with a zero balance. Pay down your debts as quickly as you can. What you want to do is establish patterns of good behavior. If you pay down your debts to zero and then the next month you max them out, and then the month after that they're back down to zero, and then the month after that they're maxed out, that's not a positive pattern of payments. Keep your balances low or zero, make your payments on time. Your credit is based on patterns and histories, not on snapshots and one time, how are you doing, what's it look like today? Because snapshots don't predict future behavior. Patterns of behavior predict future behavior. And then go easy on the applications. Don't apply for too many accounts in a short period of time. I typically recommend 1 to a year is probably not going to hurt you at all for most people. But applying for 2 or 1 a month or 3 or 4 or 7 or 8 every year will likely have a negative impact on your score, drop your score 1-2% every time you apply. If you found something beneficial, please in this video, please do like it, click the like button below, and subscribe to our YouTube channel so that YouTube knows that this information is valuable for those who are looking for it, so that we can get the word out and help people who need this information. If you would like a certificate of completion, you can go to moneyfit.org/live. And there's a link there you can click on for certificate. It'll ask you for the name, how you want it listed on your credit or on your certificate, the address where you want it sent. You choose credit and car insurance, your credit score and your car insurance from November of 2020. And then it'll ask you for the passcode, which is 20 policy. No spaces, no dashes, no capital letters. It's 20 POLICE 20 policy. Click submit, and then your certificate will be generated and sent immediately to your inbox. If you have any questions, please do call me. You see my phone number down there, my email address, that is todd@moneyfit.org. And we'll look forward to hearing from you, helping you out however we can. That's why we're a nonprofit. That's why we're here to help out. And I look forward to having you join me again in another webinar. Have yourself a great day.